Property and Casualty Insurance Key Terms. Welcome to the quiz. What is the principle of utmost good faith uberami fidei in insurance contracts? Is it A, it requires both the insurer and insured to deal honestly and disclose all material facts? Or B, it requires only the insured to act in good faith? C, it is a higher standard than ordinary good faith? Or D, it applies only to marine insurance? The answer is A. Most contracts require ordinary good faith, but insurance is a special contract of utmost good faith because the insurer relies heavily on the applicant's honest disclosure of risk facts, health, driving record, property condition, that only the applicant knows. The insured must disclose all material facts, even if not asked, that would influence acceptance/premium. The insurer must also act fairly in claims/renewals. It is mutual. Higher than ordinary good faith. Applies broadly, though historically strong in marine. Utmost good faith demands full, honest disclosure from both sides. Next question. What is a retroactive date on a claims-made liability policy? Is it A, a date after which incidents must occur for coverage to apply under the policy? Or B, the date the policy was retroactively canceled? C, the date the policy was issued? Or D, the date a claim is reported? The answer is A. Claims-made policies cover claims first made during the policy period or extended reporting for wrongful acts that occurred after a specified retroactive date or retro date. Acts before the retro date are not covered, even if claimed during the policy. This limits the insurer's exposure to prior unknown risks. Not cancellation date, not issuance date, not report date. Retroactive date defines the earliest date of covered acts in claims-made coverage. Next question. What is the purpose of an installation floater? Is it A, to insure materials and equipment while they are being installed at a job site? Or B, to provide liability coverage for installation work? C, to cover installed equipment after completion? Or D, to float the insurance premium during installation? The answer is A. Contractors risk damage to property they are installing, e.g., machinery, fixtures, HVAC, during transit and installation. An installation floater, inland marine, covers that property against physical loss from covered perils until the job is complete and accepted. Post-completion is property or completed operations. Not liability. Not premium float. Installation floater protects materials/equipment during the installation phase. Next question. What is a valued policy law? Is it A, a state law requiring payment of the full policy face amount for a total loss from a covered peril, regardless of the property's actual cash value at the time of loss? Or B, a law determining the value of all insured property? C, a regulation requiring policies to be valued annually? Or D, a law that applies only to valued policyholders? The answer is A. In certain states, valued policy laws, often for fire or specific perils on buildings, treat the amount of insurance written on the policy as an agreed or valued amount. If a total loss occurs from a covered peril, the insurer must pay the full face amount stated in the policy, even if the actual replacement cost or market value at the time of loss is lower. This prevents disputes over value after total destruction. It does not require valuing all property or annual valuations. It is not limited to certain policyholders. Valued policy laws force full face payment on qualifying total losses. Next question. In workers' compensation, what does experience modification mod factor do? Is it A, adjusts an employer's premium based on its loss history compared to other similar employers? Or B, modifies the benefits an employee receives? C, adjusts for the experience level of the workforce? Or D, modifies the policy terms based on experience? The answer is A. The experience modification (mod) factor compares an employer's actual workers' comp claims history, frequency, and severity over recent years to the expected loss rate for similar businesses of the same size and class. A mod above 1.00 increases premium, poor experience. Below 1.00 decreases it, good experience. It rewards safety and penalizes high losses. It does not change benefits. Not workforce experience level. Not policy terms. Experience mod tailors premium to actual loss performance. Next question. In insurance, what does the term indemnity refer to? Is it A, the principle of restoring the insured to their financial position prior to a loss? Or B, the principle of paying the insured the full policy limit regardless of loss? C, the principle of providing a profit after a loss? Or D, the principle of paying for losses caused by intentional acts? The answer is A. Insurance fundamentally exists to protect people and businesses from financial ruin due to unexpected events, not to make them richer or punish others. Indemnity is the core idea that after a covered loss, the insurance payment should put the insured back in roughly the same financial spot they were in before the loss happened, no more, no less. This prevents people from profiting off claims, which would encourage fraud or careless behavior, and keeps insurance fair and sustainable for everyone paying premiums. Paying the full policy limit every time would overcompensate on small losses and violate this no-profit rule. Providing a profit after a loss turns insurance into a gambling win rather than protection. Paying for intentional acts usually gets excluded because those are deliberate choices, not accidents, and indemnity focuses on accidental, unforeseen harms that restore position without rewarding wrongdoing. That's it for today. Don't forget to like and subscribe. Tell us how many you scored out of 6 in the comments, and let me know what topic I should post next. Bye.